Welcome back, everyone. Michael here with Offshore Citizen. Today we're going to dive into a topic which has been requested a few times, and this is the subject of international tax planning optimization for Australian residents. Okay, so in other words, if you are an Australian resident, how do you devise international structures to pay the lowest legal amount of tax possible? Or how do you do offshore tax planning for Australians? Now, I'm going to start by framing this and saying that, look, Australia's got some really complex rules. I've heard some people say, actually, like a terrible thing to say, I thought, was, hey, listen, it's not that big a deal in Australia. The IRS is who everybody's afraid of. This is nonsense, okay? Complete nonsense. The ATO, that's the Australian Tax Office, are some of the most aggressive tax collectors in the world. There is very few countries in the world that I would rather deal with than the ATO. Or not, it's not about dealing with them, having them they're very tough, okay? And some countries, the tax authorities aren't assholes, right? For example, Hong Kong, they'll actually kind of help you with hey, if you do it this way, you'll pay less tax. The ATO is not this, right? The ATO, they like their rules, they like to be strict, they like to be harsh, they monitor things pretty aggressively and pretty efficiently in terms of monitoring large financial transactions through the country, etc. So yeah, they're not ones to mess around with, and you need to be very careful if you're going to plan things accordingly. This means, of course, that for Australians, if you're willing to move abroad, then that's going to be helpful. Now I'm going to talk a little bit about how those rules work as well in here, but I'm going to focus a bit not just so much on moving abroad and how you have to deal with that, but also if you want to stay in Australia, how it works with foreign corporate structures and what is possible, okay? So before we do any of that, please, if you haven't already, please hit the subscribe button, nail the notification bell, make sure you hit the like or the all notifications thing. Make sure you don't miss out on any of our future videos. We try to produce great content for you about international structuring and tax and forming companies and opening bank accounts and places to live and citizenship programs and all these different things, which, by the way, if you would like help with any of those things, please reach out to us. You can book a call with me, kalamdoo.com/Michael-Rosmer, link in the description below, or check out our websites, offshorecitizen.net, offshorecapitalist.com, and send us a message through there. Okay. So let's start at the beginning. I've done some other videos previously, and I really encourage you to go back and look at some of our basic fundamentals on international tax, because I try to explain the underlying concepts like controlled foreign companies and corporate residency and all these things. But in the case of Australia, let's start with their corporate residency rules, okay? Now, the corporate residency rules in Australia are some of the toughest in the world, and they've recently made some changes in, I think it's the 2020 and 2021 year, something like that, that potentially make them a little bit tougher. So just for some context, most countries in the world have, hey, if it's incorporated here, it's a tax resident company, and even if it's not, if it's managed and controlled here, it's tax resident. And there's varying degrees, like Denmark has effective management and control, some other places have central management and control, and there's some important nuances that make certain standards harder than others, okay? Australia, for the longest time, also had, hey, if it's 100% controlled by Australian shareholders, then it's also tax resident. They have this new thing, I'm trying to remember what the term of it, but basically, if the main commercial activity of the business takes place in Australia, it is also Australian tax resident aside from the other things, okay? So the standards, bottom line, for a foreign company being tax resident in Australia are quite high. And one of the most common mistakes I hear people make is they say, oh, hey, I'm gonna form a company in Hong Kong, right? And hey, this is gonna be great as an Australian. Well, there's a very high chance that unless you have the substance really matching that this foreign Hong Kong company will be deemed tax resident in Australia. And I've just seen so many times, even when accountants and tax advisors in Australia come and say, oh yeah, you're gonna do this. And I'm like, no, that's an evasive thing. That's not proper, that's not gonna work, okay? So very, very important right off the bat to realize very tough corporate residency rules, okay? So where does this lead us from a planning standpoint? Well, the main thing that you can do is you can put the company in a country where there's a tax treaty with Australia so that you're overriding those rules with the at least moderately better rules in the tax treaty. They're never good in the Australian tax treaties, and unfortunately Australia doesn't have a very good network of tax treaties, so it's not a hugely great resource. However, it is something that is helpful when necessary. Okay, so that's the starting point. Now, by the way, I'm not going to be exhaustive in Australia's tax rules because there's lots that you could cover here, but just really briefly, the way that it works is, of course, a company can earn income. The top tax rate is 30% for smaller companies, provided it's not, there's a certain class of income, then it's 26%, dropped to 25%. So basically 25 or 30% is the corporate tax rate. And they have a system called franking credits. Franking basically means that when they pay out a dividend, you get credit for the taxes that were paid at the corporate level. And so this reduces at the personal level. The personal level, the highest tax rate is 45%, and then you've got a 2% additional rate, so really 47%. Okay, so your top tax rate is 47%. When it comes to capital gains, when you're holding them for a long term, you can get a 50% reduction. Okay, so that's kind of the array of your baseline in Australia. Okay. Now, so we want to do international tax planning. What are we going to do? Well, we're going to form a company abroad, of course, and the company, we're going to have to make sure it meets Australia's tax residency standards. As I mentioned, those are pretty tough, but genuinely not having the primary commercial activity of the company in Australia, and not being managed and controlled in Australia, and potentially not having control by the shareholders. That's a little bit trickier on that one. Okay, so all of those things abroad. Okay, that's our starting point when we're trying to do this planning. Now, the next thing is, should that company be owned by a foreign company or not? Okay, or sorry, a domestic company or not. In other words, like in the case of Canada, I've done some videos on this. Oftentimes, you want a domestic holding company to own the foreign company, and sometimes that will allow you to bring it back. So most of the time, Australia does not have a participation exemption. They don't have some special holding companies regime. It's not a very good system for bringing money from abroad into Australia. All right, so pretty much all of our tax planning from an Australian international tax planning standpoint is deferral. We're saying, hey, listen, let's put it abroad, the income abroad. Let's put it in ideally as close to zero tax environment as possible, and let's keep it there. Okay, that's the first thing. Okay, great. So off we go. They do have, under certain cases, if you have an over 10% participation in a foreign entity, they have something called NAIN, which is non-attributable, non-exempt income, and that income can be not taxable. So basically you can bring it back to the parent level without tax. There's some nuances of that. It comes from some tax rulings that were done. So that's something to be aware of. Maybe that could be useful to you, okay? Now, what's next? Of course, the work of the company can't take place in Australia. We've already kind of established that with the commercial activity. Fair enough. This brings us to the subject of management and control rules, okay? Or sorry, of controlled foreign companies rules. Controlled foreign companies rules in Australia are also, maybe unsurprisingly, fairly challenging to deal with, okay? So again, go and check out our video on controlled foreign companies. We can cover that. The standard for a controlled foreign company in the case of Australia is 40% from a single shareholder, okay? So it's up to, I think, 5 shareholders collectively holding 50%, but 40% if it's a single shareholder. So be aware that it's that below there. So if you had one Australian who was partners with one American, and you jointly owned a company and you owned 50%, you would exceed that 40% threshold, which is not the case in, say, places like Canada and the US, etc., right? So it's a higher standard. Again, note that Australia is pretty aggressive. Now, that's not true, though, in what they call listed countries, okay? So listed countries, you probably don't want to have a company in a listed country anyway, but the main useful one, I guess, is UK, or historically UK. It won't be so much as it goes up, but there's UK, New Zealand, Japan, Germany, France, US, Canada. I believe these are the 7 listed countries. So basically, they give you special treatment for listed countries versus not, and one of those is you're exempt from controlled foreign companies rules in almost all cases if you're in a listed country. So you can say, okay, wonderful, that's great, right? Okay, what's next? So you have to kind of figure out how to work around these rules. Now, these rules don't apply to all income. There's like attributable income, and you have to play around with, is that the case in your situation? For sure, your passive income has issues. And so, again, the controlled foreign companies, basically in general, the anti-deferral rules in Australia are pretty complex. Even when we look at the standard of control, so I was mentioning that 40% test. So they have actually 3 tests that they use for how they can measure control. And they're going to go through and say, hey, do you hit this test, you hit this test, you hit this test. And if you hit any one of those tests, then it's automatically meeting that threshold, and it could be a controlled foreign company. Okay, so there's like, I'd have to remember what the specific terminology they use, but it includes indirect control and some other things. So they can catch you a lot of times, even when you think they would not. Okay, so how would we get around that, right? What do we do for planning? Well, I mean, of course, you could be in a situation where, say, you're like a 1/3 partner in a foreign company, and that could be a possibility, right? It allows you to defer. You could be a partner who is below a 40% threshold. That's also, maybe you're doing like a 65-35 split with a foreign partner, something like that. That would be another option. Of course, you could be in a listed country, but that's not going to help you on the tax side in most cases, although there are some rules around basically what you could maybe do is you could have a dual tier structure. So you basically have an Australian company that owns a foreign company in a listed country, which owns a foreign company outside a listed country. And there's some special rules around how they deal with if a CFC is receiving dividends from abroad and things like this. So that gets a little bit more complicated, but you can do some fancy planning in that regard if you have the scale to justify it, okay? What's the next thing that we need to, or that we can consider? So probably the most useful structure for Australians, if you can be in a situation where you're saying, hey, listen, deferral is my primary goal, right? I want to set up a structure abroad. I want to earn a whole bunch of income there. I want to defer that income. I want to pay as little tax, and my goal is to grow it, and then sometime in the future I'll bring it back, right? If that's your goal, you can utilize trust structures. Now, almost no trusts will qualify, okay? Australia has 4 immediate anti-deferral rules for foreign trusts, okay? So they have a lot of rules to try and prevent you from using foreign trusts. That being said, it is possible to use an irrevocable discretionary trust where there's multiple beneficiaries in order to do that, okay? So this has to do with how Australia perceives trusts, and they more or less perceive trusts, in most cases, kind of like a partnership, and so the income is basically flowing through and attributable to the beneficiaries, okay? So you can't, whereas in some cases, the trust is more viewed as a separate legal entity. Here, it's like it passes through, so the only time it doesn't pass through is when it's unclear what the attribution would be to any given beneficiary, okay? So that's something to be aware of as well that could be useful for you. It's also useful for if you go abroad, and I'll cover that in a second when we get into the personal side of the tax, okay? So what would we do? We would possibly have a foreign trust. It would be a properly structured trust. The foreign trust would then end up owning a foreign company. That foreign company, again, genuinely foreign tax resident, genuinely not having the operations taking place in Australia. Okay, great. You could potentially defer limitlessly there, and you could potentially reinvest that money and grow it until in the future, when you do a distribution back, it will be taxable if you're Australian tax resident, okay? Before we go on to the next one, it is worth noting that Australia does have a general anti-avoidance rule. I've done a video on that. And they have something called Diverted Profits Tax, that's another one. And they have a multinational, MAAL. It's a basically specific tax regime that also is designed to go after some of these cases where you have multinational companies utilizing some special rules. And they also do something, it's called a SGE. Anyway, they have some special taxation for basically it's certain global enterprises, okay? SGE, something global enterprise, whatever it stands for. And so there's a lot of rules that they have to try and prevent things here, and they're very good at it, right? So be aware of that. However, there is a good news, which is good news. Look at me. Anyway, the thing that sometimes can happen is you're pretty good with advance rulings in Australia. So you can get the ATO to do an advance ruling, and that ruling is binding on the ATO, meaning that basically they have to adhere to it. So I have seen some cases where, to my utter shock and amazement, I've had clients where there was an advance ruling saying, hey, listen, we're going to allow you to get away with this more or less because they're saying, hey, listen, I'm going to leave or I'm going to do this. And so there's some kind of flexibility in there that can be a little bit useful, okay? Now, that being said, let's say you're Australian and you think, okay, perfect, I'm going to set up this foreign company, or I'm, I don't know if I want to go through all this stuff, or maybe I have set up and used this trust structure, etc. Now, I'm wanting to leave. How does this work? Well, first of all, let's recognize there's an exit tax, okay? So basically, all of your assets have a deemed disposition except for Australian real estate. Now you can postpone the payment of that tax until those assets are sold. Okay, so you have kind of this binary way of going. You can say, okay, I can pay the tax now or I can pay the tax later. If you pay the tax later, then you're probably paying it on a larger amount, so it probably benefits the ATO, right? So that's the first thing that is, not great. Second of all, Australia's personal tax residency rules are quite historically, they're very ambivalent or ambiguous and quite strict, okay? So often they will let you get away with leaving. That part's not really your big issue. Your big issue is when you come back. And I've noticed this in a bunch of countries where they don't give you a hard time, but you come back. And there was a recent court case where somebody had been out for like 9 years and came back, and the ATO decided to say, hey, you were a tax resident for the entire time. So be super aware of that, all right? Under their present rules, okay, if you're in the country for more than 183 days, you're a tax resident, or 183 days or more rather. If your domicile is there, unless they can ascertain that your home is somewhere abroad, okay, or if you are supporting children in Australia. So any of those, and there's some other things. Now, they've lost a case a while ago, and this has resulted in them proposing some new changes, which they call a bright line test, which basically is designed because right now it's very ambiguous, right? You can say, well, am I resident abroad? Am I not resident abroad, etc. By the way, I heard somebody say recently, oh, hey, you can be resident nowhere as an Australian. If you're going to go back to Australia, very, very risky, extremely risky, okay? And by the way, like a paper residency doesn't work. You can't say, hey, listen, I'm going to go and I'm going to set up a company in Panama and be, okay, they're ending the Friendly Nations visa, but let's just say back then, hey, I'm under the Friendly Nations visa. I have to visit, once every year, or once every 2 years, whatever. I'm, really not going to live there, but I'm going to have my residency there. I'm going to tell them that's where I am. That will not fly in Australia. Like the genuine substance, you actually have to live there. You actually have to have your home there, etc. I highly recommend, if possible, using a country with which Australia has a tax treaty, and I'll get into that in just a second. This being said, yeah, it's something that you definitely want to take quite seriously, okay? So now let's go to these draconian new rules. So what they've proposed is that if you are in Australia more than 45 days in a year, you could be subject to tax, okay? Definitely if you're there 183 days, but 45 days is their proposed number, okay? And at that point in time, there's these series of tests that you would go through. Do you have the right to live in Australia? Do you have economic ties? Do you have, I think property might count as economic ties, but I think there's another separate one for like dwellings or something. And there's a fourth one. I can't remember off the top of my head. But anyway, bottom line is, if you have 2 of those, you can end up being taxable in Australia. This is not passed yet, so we'll see. Hopefully they push it, because it's just so ridiculous to suggest. By the way, like, keep this in mind, that basically, if you're somebody who has an Australian passport, then you've already met one of those tests, right? So now one more, like, you're like, hey, I still kept business there. Oh, that's a problem. Oh, I have a property there. Oh, that's a problem. On and on and on, right? It can be family is another one. If you have family in Australia, and I haven't heard any definition of what family is. So this can be really, really brutal, okay? I cannot caution you enough that it's important. Now, here's the thing. Under even the proposed rules, this is overridden by an applicable tax treaty, okay? So if you're going to become resident in some country where Australia has a tax treaty, then that is much better, okay? Much, much better. Be aware, again, they don't have a very extensive list of tax treaties. So for example, notably, Portugal is not on the list of tax treaties, right? That's not so good, right? So Thailand is, Malaysia is, there's a few other places that are. These would be places that are maybe interesting if you're an Australian to go and live, because of the fact that you can say, okay, at least I can override the local tax rules with the tax treaty rules, and that can benefit me. So anyway, let's see. I'll just quickly recap for you guys because I don't want to make it too long. Like I said, it's very complex. If you have questions, please reach out to me. Go through it. Australian clients are, it's like some of the most complex tax planning we'd have to do. So when we go through with people, it's like, you end up doing a big report in these cases. Anyway, so first of all, if you go abroad, you have to pay an exit tax. Be very, very careful about going abroad and what standards you meet for actually genuinely being resident abroad, especially if you plan on coming back to Australia as a resident. Okay, very, very important. Number two, if you want to stay, you're going to need to make sure you set up a foreign company. The foreign company genuinely meets their standards of corporate residency, which are, I think, probably the toughest in the world. I don't think I've actually seen any country that has tougher laws in this respect than Australia. Then on top of that, you need to make sure you're not dealing with their Cfc rules. Their Cfc rules are, their threshold is 40% for a single person or 50% for five or less Australian shareholders. And it doesn't necessarily apply in all cases, so we can get into the details about that on a case-by-case basis, but in a lot of cases it applies. The opportune way that you can potentially defer, if you're not able to do so in another way, is through the utilization of a foreign trust, but the trust has to be really properly set up, and you need to make sure that you're not going to trigger the generality avoidance rules or the diverted profit tax rules in the process. So bottom line, very complex, very tough jurisdiction to deal with, not a tax-friendly jurisdiction at all. The ATO is brutal. However, there are options if you're willing to, if you have sufficient scale that you can justify the investment of doing it, properly. So I hope that helps. If you have any questions, as I said, please reach out to me, put them in the comments below. If you have some other country you'd like me to kind of do a review on their international tax system, please put it in the comments below. If you like the video, give it a thumbs up, share it with your friends. If you want help, book a call, calendly.com/Michael-Rosmer, link in the description below. Hit the subscribe button if you haven't already. And I appreciate you guys. We will see you on the next video.